Good afternoon. This is Ken Long at Tortoise Capital with a lesson today on trading in normal and abnormal times. Part of this lesson concerns our use of histogram analysis to help guide our decisions on when to adjust our trading rules, but also for the insight that it can give you as far as what kind of trade you're in and a change in market conditions. And so I'm asked a lot of times to evaluate a strategy and what I think about it. What I think about it is based on what the histogram of the results look like. And I look for three things. And so let's just take a quick look at this kind of busy chart. So a trade that got 0R would be right on this black line. And then a 1R, I look for positive 2R. And I look to see where the average loss is and then the average win. And so I'm very concerned about the shape of this curve between minus 1R and plus 2R. And so the first thing that I look at when inspecting the histogram is, are there any losses greater than 1R? If not, then that says the trader or the system are reasonably adept at identifying and then managing to a standard unit of risk. If there were losses greater than 1R, or if there were a lot of losses greater than 1R, then I'd be concerned that we don't understand the dynamics of the situation and we are not capable of quantifying that risk. So in my view, in my trading, I try to never take a loss greater than 1R as a way to have a firm grip on what my risk is. I really consider any loss that's less than 1R to be a positive gain. So if this average loss was 0.7R, I would really see a 0.7R loss as a 0.3 gain. In my mind, I've already written off the 1R loss from the moment I entered. Anything better than that is money back in my pocket. So that's the first thing I'm looking for, our ability to frame and manage to a 1R loss. Second thing is I look for the shape of the curve of results, the quantity of trades by bucket here, between minus 1 and 2R. In the same way that a 1R loss is the management objective, I set a criteria of a 2-to-1 reasonable reward to risk ratio as a filter for taking the trade. Now, if it looks like I'm able to have a normal looking shape between minus 1 and plus 2, then this suggests, using descriptive statistics, that there is some kind of natural recurring process that's going on that produces a shape, a distribution of results similar to the things that are found in nature that produce these normal curve histograms, whether it's height or age or whatever. So if I'm able to see a normal looking curve of results here between 0 and 2R, then that says to me that not only am I able to identify a manageable risk of 1R, that I'm able to identify reasonably achievable rewards of 2R, and then I'm looking for a positive expectancy. When I just do the expectancy of things between minus 1 and positive 2, I'm looking for a positive expectancy out of this region of trades. If I can do that, I call this the professional space. And then I'm getting paid for the opportunity to look at item number 3, which is that I want that system to be open to the possibility of wins that are greater than 2R. And then this is all gravy. I don't count on getting those. I accept them as gifts when they occur, but I'm open to that possibility that a greater than 2R win can be achieved. So I look for tightly controlled risk, normal, repeatable, natural looking distribution of results, positive expectancy between minus 1 and 2R, and then as long as I can have that, I can start now looking for average loss and average win management. If I'm able to refine my technique and start reducing some of these losses from 1 to 0.7 or to 0.5, then I'm actually nudging my expectancy to the right. And similarly, if I can move the average wind to the right over time, then I'm uh, incrementing my improvement in a favorable direction. If I'm in a trade then, and I know what my average win is for that system, and I'm beyond the average win and not past 2R yet, it's in this space above the average win between there and 2R that I'm starting to get outsized returns or a bigger than average win. And the further this goes, the more of this outsized win that I want to gain. It hurts my feelings if I have something that's better than an average win, and for whatever reason I elect to let that come back and take my exit where I now have a below average win, or I've tipped into the loss column. By the same token, if I can see tactical and technical reasons to take a loss less than my average loss, then I will have improved that portion of the histogram. So by managing the average win and average loss and using that information to shape my trade decisions, I'm using information about past results as a way to refine my management technique in this space. And then if I can score better than 2R on a win, that's the land of irrational exuberance in my mind. I want to make sure that any gains that are beyond 2R, I don't let that come back and be less than a 2R win. Otherwise, I feel like I have let the exuberance overcome my professional management technique. So we're going to see that idea reflected in a discussion from our chat room, and I'm not going to read all of this to you, but it discusses from different traders' perspectives in the chat room while we're working, different angles and perspectives on um, average trades and trading in normal days versus explosive days, and some different thoughts that are in our minds. We were on the verge of experiencing a runaway freight train of a good day when this discussion was occurring. And so I'll let you read that. This is my commentary, and I think it's worth reading. And it describes my attitude, which comes back essentially to that histogram, and that is that by attending to my craft work between -1 and +2R, it gives me not only a way to get better when the weather is good for trading, or routine or normal, nothing exceptional, but it also lets me know if I get past 2R that there's something extraordinary going on and that I need to uh, be trading with even more care by attending to the rules and not letting um, the normal, perhaps normal behaviors affect my trading, or said a different way, making sure that the abnormal conditions don't let me lose my discipline. And so I take the position that when it gets past 2R, I should be trading that in pieces and parts using the same reward to risk ratios, and just to be prepared for the fact that sudden reversals or runaway moves can also occur. So I would encourage you to read through this and look for the beliefs that are revealed and see how they resonate with you. I go back and reread these things later in order to fine tune my own beliefs to see what it is that's exactly in my head and what the implications are. So the symbol that we're going to look at is target XIV, and now this is important to note that on the day prior to the case study, one of our traders in the chat room was able to use 8-minute charts to just vector him in to an opportunity on 1-minute charts where he traded our owl pattern, which is after an unambiguous move. We have a regression line crossover outside of the river. The 10-period regression line crosses the river. He enters when both the river and when the 30-period regression line and the dragon have which is a form of 10-period Bollinger Band, have sloped up. He takes his entry when it crosses over. He manages his trade initially at Z2 and then tightens it up as he gets better and better. He starts, when he sees this out at Z3, he knows he's closer to the end of the trade than the start, so he tightens his stop, and then he takes a perfect exit here for 2R about 15 minutes later. So this was a move from 72 to 73.5, $1.50 in XIV, which on a $70 ETF, which seems like quite an extraordinary move in 15 minutes, and it really is. So here we are in a position the following day, and it's really a quiet day. There was a gap up, and then some quiet chugging along here, and really not an exceptional move. This is the entire move of the day so far, from 74.40 to 75.30, so less than a dollar the entire day. And you can see the volume weighted average price. And you notice that the gap between the three 30 period Bollinger Band Z3 and Z minus 3, pardon me, is only about 20 cents, so extraordinarily tight. We call it a sideways quiet channel. So our first quiz is, how do I interpret this in terms of our framework and mark it up? So here's the solution. I consult our daily chart. I look for XIV, and I find that the frog standard deviation, which is the difference between noise and signal on a given day, is computed by statistics. That tells us the difference between signal and noise. That's the unit of movement, if you will, is $1.11. So it takes a move greater than $1.11 to initiate a signal in our definition. The range stat then is a multiple of the frog standard deviation, which simply says that the largest reasonable intraday move based on statistics is $3.53. It's sort of the upper limit of the maximum rational move. Any move greater than $3.53 then would be something that we have begun to enter irrational exuberance. Now, in terms of scale, this yellow box represents one frog box, and that's what this yellow box is. So you can see from the open to the high of the day, it hasn't even traveled one frog box, so we could be entitled to call this noise. The fact that the Z3 lines have pinched well within inside a single frog box gives us reason to call this a special form of sideways quiet channel, and that the Z3 lines have pinched to less than a frog box that says this is an abnormally tight pinch of price. Now, the range stat I'm showing in this orange color is $3.53. That's the maximum reasonable intraday move, and if we hung that box from the highest high and low, you'll notice that this is half of a range stat, so it doesn't even fit on the chart by scale. So it would not be irrational or abnormal for this thing to move $3.50, and that's what a $1.75 looks like. So in our Z3 pinch pattern, when price is in this tight channel, we're ready to go long if it crosses the green threshold, short if it crosses the red, and then we start looking for price targets in purple. A return to the VWAP would not surprise us. A return to the open would not surprise us. A return to close the gap would not surprise us. So we could get short at 75.05, and then a move to 73.50 is only half of a range stat, a little over, maybe 1.5 or almost 2 frog boxes. So that is not an abnormally large move, but it's certainly one that could be managed. And if we use the size of this channel as our initial risk, you're talking about 20 cents, maybe 25 cents of risk, and then a potential return to close the gap of a considerable amount of gains. Now, the other thing that I notice is that the RL270, this purple line, which we treat as the long-term fair value on 1-minute charts, has been up, stalling, rolling over, and starting to collapse. And so a move to the downside could be large, and that's why we frame this thing to the bottom. Working to the upside, we simply would take a range stat, add it to the low of the day, and realize that a move up around 78 would still not be irrational. That's just how volatile this symbol can be. Now here's the actual move as it occurred. The pinch occurred here. The breakdown occurred at about 75.05, and the move got to 74.20, almost a 90-cent move. And you can see here that the entry would have occurred here. Our initial stop is here, and then tracking our trailing stop here. After this exceptional move all the way down to Z3 on the downside, moving that stop to accelerate to lock that in would not be irrational. It wouldn't be unusual for us to capture this move off this big bounce up as it's approaching the dragon, and then cashing a 4R win. If the yellow lines are places, or yellow dots, excuse me, are places where in our structure where support collapses, we would consider adding second position. So the if we were to exit at the blue bar for 4R in the initial position, there's an opportunity to pick up another couple R if we take either one of these standard additional positions. If we had taken a third position, then this would have accelerated our stop here anyway by normal operation. So there's anywhere from 4 to 10R available in this move, and I want you to notice that we haven't even gone half a range stat on this move. This was almost a frog box worth of a move, and so the structure allows us to take advantage of these what are often surprising sharp moves by not having a directional bias. So we now have another Z3 Bollinger Band pinch happening here. And so we now see that pinch has occurred less than a frog box. So we put our tentative entry here or tentative entry here. The idea, whichever breakout occurs first, we take it with a stop on the other side of that channel. On the downside, our target for a range stat price, it can still go to 71.67 without being irrational. So we're talking really another $2.50 to the downside of feasible move. Now, as a matter of perspective, when we get the full range stat on and we hang it down to 71.67, you can see just how tightly pinched that price really looked like. So don't get confused by scale of your charts. Having the math to help you predict targets or frame targets gives you a very powerful tool in your arsenal. So this was the first pinch, and now this is the second pinch. When we take that frame, it collapsed again, so we're short at about 75.20 or 74.20, excuse me. And then with our targets have returned to the open, and then a return to the gap close from the previous day. This is with that wider stop because the pinch was wider. This on the first piece, this is a 6R gain. That would be a 10R gain on the first position, with the yellow dots being places where we would standard normal add positions. The blue dots are places where after significant runs it would not be unnatural to take some profits and then with a possible re-entry. But as you try to lock in pieces, all of these become places where you have to make decisions and then suit your own psychology and money management strategy. So even on the first position, we're looking at 10R. This could have been anywhere from 10 to 20R on this second leg, after anywhere from 4 to 10 R on this first leg. So we're looking at a potential, whale of a day of possibly 30R. Well, if most of our time is spent between -1 and +2R on our trades, that's why it's so important to have those discussions about what to do when those frameworks show clearly that you have an abnormal day. So in 2017, in the first 3.5 months of the year, how many days like this have there been? Not more than 10 in XIV, but there have been some. But you have to have a guide and a framework, in my mind, that allows you to operate successfully when you're fighting for quarters of an R to improve your technique on large numbers of trades, and yet be able to transition to runaway moves and then trade them with that same kind of disciplined framework. And for us, that's what this regression line crossover and Bollinger Band framework combined with the frog boxes to give us the ability to estimate reasonable reward and risk targets, gives us the ability to navigate both kinds of weather. The most of the time when it's normal, and then those runaway days when the potential was there. The framework is really designed, and the rules that we use are really designed to protect against taking an adverse trade like this. Like, I don't want to be so locked into, I think this thing's going to win, that I sit there in about 1 hour watch a 20R move against me because I'm frozen by the magnitude of the move. The fact that we've got range stats and frog boxes help us calibrate the size of these moves, know when we're in abnormal territory, and it's always a choice now to trade in these kinds of conditions if you want. You can make a living in the land between -1 and +2, but it's also helpful to have a disciplined set of strategies that allow you to get various pieces of these moves within the size that you're capable of managing. This was the note from a trading journal from one of our traders who he got 5 out of what he estimated was an available 14. I just remind him, don't beat yourself up. You're getting paid to learn. And this was from that same trader's trading journal on the day before, where he is learning how to work these different pieces, where in this case he saw a P4 entry here where he saw a swing low, a higher swing low, creating this lazy W, and when the top of the dragon is taken out, he enters and then manages a very nice exit here after about a 0.7, 0.8 R gain. It's this kind of trade management when it goes from sideways and choppy to an indication that it's starting to become trending that we get in. And now this can be a piece anywhere, whether it's just a one-leg excursion from a choppy day and it reverts to normal, which is kind of what it looked like, or if that's simply the first leg of what turns out to be a mega move like we saw on this kind of move. The trade framework and the rule sets have to allow you to successfully navigate from inside of these two different kinds of conditions. And just notice how extraordinarily quiet this is, and then the same day, extraordinarily noisy on a Fed day. So that's what we want to say about the regression line crossover and Bollinger Band framework when it combines with the frog, and then the importance of knowing where you are, and then coming back finally to that to the histogram analysis, knowing the shape of your results, knowing when you're in the normal space, when you're in the abnormal space, and what the most important rules are in sequence in this style of trading, in my mind anyway, are that no losses greater than 1R, reasonable chances of getting out to a 2R gain, that this is the normal range of management, and that I'm looking to improve each of these trades by refined technique and deeper understanding by 1/4 of an R, so that as I get better, my average loss improves, my average win improves, and the mountain is shifting in my direction. But on those occasional days when runaway moves occur, that I'm ready to apply the discipline that I've gained in my professional space to ensure that I have a chance of getting some of those bigger wins. So that's today's lesson and quiz. It was longer than usual, but I thought it was an important one. So thank you very much for your kind attention. Keep your risk measured and your powder dry.